what is the most disastrous sales pitch you've heard recently?
Oh my
We hear them all the
gosh.
time. We hear them all the time. We're going to wrap on this. Give me your worst one.
I'm trying to think. I'm just thinking of like TikTok and Instagram Reels stuff that I keep seeing all the time. And it kind of goes around like the permanent insurance and taxes, a lot of it, and real estate. Let's see. One of the things that I've been seeing a bunch is now I'm forgetting what it's called. That exemption where basically when you have an Airbnb and then you can rent it out for yourself for like 2 weeks. The Augusta rule.
The Augusta rule.
The Augusta rule.
Okay.
I feel like that one's huge on social media right now, and people don't understand the implications of that.
Brandon Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC-registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Brandon Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
So the first thing that's crazy that happened is Joe Biden just dropped out of the race.
Yes.
And I'm not a political person, at least public facing. I obviously have my own beliefs. I do not let them drive my investment decisions, nor my overall financial decisions. I think it's a very bad approach to let politics dictate your investment thesis unless you are a short-term trader, literally trading the political landscape, right? So if you're very specialized in that, then overall, go for it. But for like the average person or average investor, it's a recipe disaster for most people. And the lead up to this, though, watching it, you could see that Joe had started making all these kind of statements. Like things started to fall in place where you're like, okay, he's gonna drop out. I mean, that dude is technically still alive, but dude, he was like the Walking Dead on that debate stage. It was kind of crazy. Okay, so since then, the markets have been pricing in this Trump victory, which again, like I'm not saying you should, start playing the markets this way. I'm telling you what's just been happening, right? And then this last week, as it's like, okay, Joe's going to drop out probably. Mm-hmm. And then there's all these theories and conspiracy theories about, they're going to, what they call the hot swap and swap in a new candidate. And I don't want to get too political on my commentary of all this, but the effect that it had is uncertainty and sort of chaos, right? And so the markets last week were selling off pretty aggressively. Mm-hmm. Now, that's noteworthy because what is evident, or what that's evidence of, is the market is a forward-looking discounting mechanism. So the market had to price in this uncertainty and chaos and actually really unprice what it had started to price in via Trump victory, saying, oh, well, we're uncertain now of a Trump victory and what that looks like. So people start doing different things. Mm-hmm. If you're, what I'm going to say, average person, you're like investing for your retirement, mm-hmm. 401k, IRAs, whatever. You're not a professional trader. The best thing you can do in these situations typically is just wait.
Yeah, nothing.
Because it just priced in a Trump victory and then it priced in uncertainty, and it could price in a Trump loss.
Mm-hmm.
But if you're well diversified and your planning's intact, there's probably something else that's about to get priced in that's favorable, for whoever that other candidate is.
Mm-hmm.
And those things tend to manifest themselves in the broad market in different sectors. But if you're well diversified in your portfolio, you're probably going to be, we don't guarantee anything. Probably going to be okay.
I think it's one of those times where it's like the emotions start to drive the behaviors. And so we have to, even though you're looking at political information, it's still your biases based on the political parties and what you think might happen is what gets a lot of people in trouble, is when they start making changes to their long-term portfolio and plans, when they know, like, okay, this is long-term. This is what I planned for. I planned for these ups and these downs,
Mm-hmm.
these different things that are going to happen with an inefficient market maybe, or, whatever. Yeah. And then they let their biases and their emotions cloud their judgment and make poor decisions, when sometimes, like you said, the best thing to do is nothing at all.
So one of the things that I try to help people understand is risk.
Mm-hmm.
And people ask you this question all the time. They say, where's the safest place to invest your money?
Yep.
And what's funny is it's like, there is no safe place to do anything. Nothing in this world is actually guaranteed. And it all depends on the lens through which you view the world. Okay. Mm-hmm. So you always have some kind of risk. Now, that risk might really manifest itself completely different than how you've been taught to think about risk, but it is still risk nonetheless. Mm-hmm. So let's talk about a couple examples of some stuff I've run into recently that I think are valuable to talk about the risk that somebody faces in a certain decision. What type of risk do they have in some different decision-making processes they're thinking about? And then how can you plan around that to maybe manage those risks differently?
Okay.
So one of the first ones is, like, people say, well, what's the safest place? And so then, the high yield savings and money market comes up, mm-hmm. right? A funny note to think about is people will say, well, high yield savings is better than money market because it's FDIC insured. Depending on what the money market holds, if that money market is holding treasuries, there's two things. You could potentially have a better tax situation, right? You could be state income tax exempt on treasury income. But also, who is the FDIC insurance? It's the federal government. So you can have FDIC insured, or you can just have the federal government owe you money. But to me, I'm feeling like if the government owes me money directly, that's almost better than FDIC insurance. So it's not technically, but I feel pretty good about it. So from I'm going to use air quotes here for those that can't see me, risk-free environment, right? And what we mean by that, oftentimes when people say it, is you don't have the risk of losing principal, right? So if you put $100 in, it's the risk that you're risk-free in the sense that the $100 will still be there.
Yep.
But what are the risks that somebody might face if they say, well, I'm going to put all of my money in CDs, high yield savings, money market, whatever?
Well, you have inflation risk, number one.
Oh, yeah.
And that's huge. And I think a lot of people forget about that, especially when they're keeping the majority of their funds in high yield savings, CDs, cash, mm-hmm. money market type things. Right now, we've got like a 3% inflation rate, but if we look back over time, it's as high as like 9%, right?
Well, and that's the aggregate. But
yeah,
what if your big expenses aren't buying new housing, but your biggest expenses are buying energy and food because you're retired?
Yeah.
And has been significantly higher than that even, right?
Yep.
So inflation risk is tough for people to remember because you don't see it in the account, right? You see your account statement and say, man, all my money's still there. Mm-hmm. But what you can do with that money is being degraded over time. And so that's a big risk that they take on. And the only way to counterbalance that, and this is going to be an important thing to remember throughout this whole conversation, is remember you have let's call it a total number in your portfolio of 100% risk in your portfolio. It's just allocated to different places, right? But the sum of all your like weighted risk would be like 100%. You always have risk. So you can trade inflation risk, and so you can have more safety or less risk of principal loss, but you're going to take on more inflationary risk.
Right. So you're trading like the market risk for the inflationary risk.
Yeah. So then what? Yeah. So what's a risk that you can take on because now if that's your main idea, you have to hedge that. So that's how you build a portfolio. You start hedging stuff, right?
Right.
So how do you hedge that inflationary risk?
You've got to go and get some market risk.
Yeah, you got to get some market
risk. You switch one risk for another, and depending on, what your immediate needs are, your long-term plans, and all those goals are, you've got to figure out what types of risk you're willing to take and how much of those risks you're willing to take.
You are going to have to take on risk of losing principal at some point in order to get the inflation. Now, there's probably some insurance agents out there that are going to be in the comments or whatever, and all upset because they're going to say, well, we have this product and it can give you, zero floor risk. You can't lose money, but you can make, up to 12 or 15% with the market, right? These index products. So we're talking index universal life or fixed index annuities. And there's some other stuff on the fringe of those too, but those are the two big main ones, right? When you hear that pitch. So, if people are looking for a safe play there, what they're typically looking for is that safe, what we're using the word safe, but we know that's not truly safe because nothing's actually risk-free. So you have, get some form of guarantees against loss of principal. But how have you seen that play out for people?
So again, there's trade-offs for everything that you do. So there's a different type of risk. So one of the risks that you face when you are protecting the principal like that is the risk of loss of liquidity. So it makes it harder for you to get access to your money quickly, or there's penalties that are involved. And so you may have to pay a fee to be able to access your money when you need it. So there's just, again, it's just shifting the risk from one type to another. And you have to ultimately determine what types of risks you are comfortable taking and need within your portfolio to accomplish your goals. And most of the time, I think you'd probably agree that it's important to minimize those risks to a certain point, but you need to diversify among those risks too, right?
Yeah.
So you're going to have a combination of all of these within a good balanced portfolio that's looking at all the different aspects here instead of just focusing on like, I want to be air quotes safe and put it all into these, protecting that loss of principal risk, but forgetting about all of the other types of risk. Like you can't just choose one and call it good.
Yeah. Yeah. It's always what risks are you comfortable in what amount? So a couple things about the index products. Illiquidity premium is an investment term that investors should absolutely demand. So the less liquid an asset is, the more that you should demand as a return. And the reason being is because it's harder to get out. So when things go sideways, you're going to take potentially a bigger loss. Now, consider this, going back to what we first talked about, is on something like an insurance product. Your illiquidity premium, they're going to say, well, you're guaranteed you can't lose money because of these guarantees that the contract likely has or may have. And that's okay. But what about your inflationary risk? So there's an opportunity cost potentially, right? Just what if inflation comes back, you're in a contract that says you can make, 2 to 6% a year, and inflation's clipping away at 9% year over year, and you can't get your money out. So in order to take on that type of risk, you want to have a premium. Well, I don't think that's necessarily a acceptable risk parameter for most people right now, right? Like the risk reward, or what sometimes I'll call like your pain to gain ratio, is not always in line. The other thing is, I caution people. I have seen the most money lost sometimes in what was supposed to be the safest vehicles. Okay. So, sometimes the more something's being sold to you as safe, the more you should be cautious. Permanent life insurance, I 100% do believe falls into that category. If you have a rock solid plan around why you own that, right? It's a legacy asset. It's working in conjunction with your estate plan and your trusts and your, how you're funding things for the next generation. It can work out really well, right? Like those products exist for a reason, and there is an appropriate application. There's nothing wrong inherently with the product.
Absolutely.
But if you take it and that is supposed to be, I'm going to use air quotes here again, your financial plan, then you can end up getting several years into these contracts. And what I have found after looking at, obviously, okay, we're licensed to sell these. We help people with them from time to time. I more times than not run illustrations, which is like a quote, to show somebody how it doesn't work than to show them why it would work in their situation. And it's typically, and I've reviewed at this point hundreds of policies.
Yeah.
It's typically about 10 years under ideal conditions in a permanent life insurance policy that you'll break even to having the same amount of value in the contract as what you put in. So if you put $10,000 in a year, theoretically you'd have about $100,000 in 10 years. You haven't make any money for 10 years. And so what's the disaster is when people get to year, 5, 6, 7, they've put $50,000 to $70,000 in a contract like this. And they decide, you know what? I can't, this isn't going anywhere. The market's going north. I can make all this money other places. I don't even need that much life insurance or whatever, XYZ reason. Or I lost my job and I can't pay the premiums anymore and I have to cancel the policy. Yeah. Right. There's all these things that can happen. Life is unpredictable and they end up, so they overcommit to this idea. And now what was supposed to be a safe vehicle that they couldn't lose money, they've now lost, anywhere from $30,000 to $50,000 in this type of scenario.
Well, here's another part of that too, that I think a lot of people don't understand or even know that this is an issue, is that these policies are fairly new. They haven't been around for that long yet.
About 20 years
comparison.
Or so.
Yes. And so one of the things in these illustrations that people will see, like those quotes that you mentioned, is they quote it based off of the cost of insurance that the companies are using right now. But within these policies, they can change that cost of insurance at any time during those policies. And because we have seen higher inflation lately than in the past, there's no telling what the cost of insurance could go up to and how that can impact the overall returns that you receive in those policies and what that's going to look like for your cash values and all of that's available for you.
Yes, there's so many things that can go wrong. The actuarial tables can completely change. Now, in the interest of fair discussion and conversation, insurance companies can't just unilaterally say, you know what, we're just going to raise the premium so high. Right. There is a regulatory process that they have to go to the states and they have to submit and say, here, we're wanting to raise the premiums and here's our justification for it. And here's what we're going to do. And right. So they can't just go and
just change
10x your premium next year. Right.
Right.
But the environments can change and, small changes can grow to big changes. And if you have a policy, because it's supposed to be safe, you want a policy with some guarantees. And if you don't like the guarantees that are available in that policy probably isn't for you. It's generally what I help people understand. But that's just something to be considered. Again, it's like, so if you're looking for the safe investment, it might not be as safe as you're always thinking. So there's a risk. Now let's talk about like an index annuity or a life insurance contract where everything does go like according to plan, right? Like it was the right size. It was the, your job situation never changed. You could always fund the policy. You had it structured correctly with the right riders and you were overfunding it the right way and like all the things and the crediting works good and it's all treated great. What risk does somebody still carry in a strategy like that they're not thinking of typically? It's the credit risk of the company.
Yep. So
you can have this, what, people are viewing as some kind of savings account or investment account, whatever. But at the end of the day, if you have your money in that insurance company, remember that it's not a sub account. It's not like a checking account at the company. It's not FDIC insured. And your money is being invested through what's called their general account. And if they go under, there's no guarantee that you get your money back.
Yeah.
So that guarantee, remember when we talk about insurance, is only as good as the promisers or the guarantors' ability to pay it. And if they're not there to pay it, there is no guarantee, right? So that's why I don't even like using the word guarantee around insurance. It feels dirty coming out of my mouth, even when we're talking about insurance. But that's a huge risk. So you have to be careful. If all of your eggs are in one company's basket and you have a lot of very heavy insurance plan, that could be a risk that you're carrying that you're not even thinking about.
Yep.
And then same goes obviously like in the annuity space, right? So if you use an annuity, viewing it as like you're buying a pension, remember like that pension is being now provided by the insurance company. And that's good as long as the insurance company's still around. And most companies are pretty solvent, but you want to do a little bit of research and due diligence to make sure that if you're taking this risk of concentration risk now, right, is what you would call that, is do I feel confident that that company is going to be solvent and able to pay this throughout the remainder of my life, right? Like I want to make sure that I'm committed to this contract. How committed are they?
Yeah.
And there's a lot of great companies out there that have good balance sheets, that have good credit worthiness, but there's some that, they're on the fringe, and there's some that look good today, but could easily, right, get knocked down. And we saw that in 2008. I mean, we saw AIG go bankrupt in 2008, and theoretically everyone that had policies there should have lost all their money. Now they got bailed out, so people didn't, but there's no guarantee that somebody's going to get bailed out again.
Yeah.
Right. Bear Stearns, everyone at Bear Stearns, right? Bear Stearns got bailed out. Lehman didn't. So, it's just,
you're taking a chance.
You're taking a chance,
risk.
right? So there's risk. So there's inflation risk. There's concentration risk. So, and even in all these things that are supposed to be safe, there's
still some level of risk.
There's some level of risk, and it's important to understand. And once you start to, what I have found is once you start to understand all of this risk, now when you talk about market risk, let's talk about market risk. It becomes not all that scary anymore. No one, don't get me wrong. No one likes to see their account balance go down.
Right.
No one does. No one has ever opened up a statement and gone, woohoo, I lost some money. You know what I mean?
Yeah.
But have you really lost money? That's the question. I'm working with someone recently that is working towards retirement. They have a very sizable, well, I'm not going to use the word very, they have a pretty sizable 401k from an employer. And this person is not a savvy, money person, right? Very, very, very modest individual, not financially complex. And their cost basis was like less than a tenth. So when I got their statement and you could look at it, contributions, and it had all the contributions over time, it was less than a tenth of what. So they had 10x their money in their 401k by just investing in the market and letting it wait. And this person went through the .com and 08, right? And COVID now for what it's worth, and my point being is, first off, if somebody tells you 401ks are a scam, they're either ignorant or they're trying to sell you something. Either way, it's not in your best interest to listen. And that's a perfect example of why. So this person could have easily said, well, I want something safe. I'll just, I'm not going to invest in the 401k because that's going to put money in the market, quote unquote, the market or something. Yeah. They didn't. They put it on like this simple, they set it up, had contributions going in. They had some employer match. They had, the market working for them over the years. They did really well. And they don't know, and that's the beauty of the US. They didn't know anything. They couldn't tell you what their investments were. Yeah. Now, like for me, that scares me. That's some risk that I would be like, oh my gosh. Yeah. How do you not know what you're invested in? But because of the access to mutual funds and, broad diversification and
they're just using very general.
Just really general stuff. They did okay. You know what I mean? And they're going to be able to put together a decent retirement now because of it. Yeah. But they were willing to take on the market risk. And that really was what helped get them there. In hindsight, they didn't really realize they were necessarily doing that, but that is what helped. Okay. So market risk. Your statements are priced in US dollars. Okay. They do not, when you open it, like on the front page, it always says your account value as of whatever is X. It never says your account value as of X is 185 shares, right? Like no statement ever has done that. But the value of your account is just the sum of what it is if you sold everything at that point in time.
Mm-hmm.
Your account doesn't hold dollars. So market risk is the fluctuations oftentimes. Really if we took this conversation deeper and we talked about like single stocks and, individual names and, and you have, market risks and systematic risks, we're going to talk about just in what most people are looking at, which is going to be your index funds, whether it's ETFs or mutual funds, just broad market, well diversified ideas.
Okay.
And now I lost my train of thought just a little bit here. Okay. Market risk. You're going to see markets go up and down.
Yeah.
Right. And no one likes to put in $100,000 and then see it go to 95,000 and then it go to 108 and then it goes back to 99 and then it goes to 112, but then it goes to 104, but then it goes to 100 and whatever, all these things. But what you notice is it's slowly creeping up. And at a point it was less than what you put in.
Yeah.
But over time, the reason that the market risk is something you want to take on is because it offsets so well the inflationary risk.
Yeah.
And the reason why it is a good vehicle to hedge inflationary risk is because in business, right, when you buy that index fund, right, and you're buying a basket of companies that are out making sales, like, have you paid more for stuff recently the last couple of years?
Absolutely.
Who would you pay more money to?
Everyone.
The businesses?
Yeah.
It's like, so who's going to hedge inflation the best? Well, businesses, because that's how that's how inflation's measured, right? Yeah. It's like, how much money do us as consumers have to spend on stuff? Well, when we're increasing that spending, even though it might be for the same thing, it's because we're giving it to businesses. Mm-hmm. Well, that's that bit. The business is then running that through their P&L, and that's their revenue, and mm-hmm. What trickles down to their profits. Well, when it trickles down to the profits, that's value to shareholders. So you want to be a shareholder. Yeah. Okay. Now we could do a whole podcast on which companies or sectors or industries are going to hedge inflation or do the best in inflationary cycles. But overall, equities are going to, because at the end of the day, if you're an auto mechanic and you do 1 hour of labor last year for $100 an hour, and you do, and now we went through this inflationary cycle and now you charge $110 an hour for labor or $150 an hour for labor, you're still doing 1 hour of labor, mm-hmm. right? All we're doing is changing, hey, there's been more money that's printed and all more money that's given, but it's still an hour of your time, right? So it all converts back to time and energy. And that is what will hedge off inflation, because you're trading still in time and energy. It's just being denominated in dollars. Mm-hmm. So markets go up and down, and that's the market risk, but it hedges the inflationary risk.
Yep.
Why does someone not just want to say then, well, I have 20 years to go, I'll just put it all in the market?
Because there are going to be times where that is too much risk. It's concentrated risk, all on market risk.
Yeah.
You need to, again, have a diversification of these different types of risk. Mm-hmm. And I mean, yeah.
Okay. So, if you were to do that, you're saying, like, you know what? I'm a risk-loving person. Even though I'm entering retirement, I am going to have 30 years of retirement or whatever. Mm-hmm. And so that's a long enough time horizon. I'll just keep it all in equity still, right?
Gotcha.
The issue that you run into is going to be one of the things that I take into consideration quite heavily is your sequence of returns risk.
Absolutely.
Right. So you have to have some way to smooth out the ride a little bit and have access to the money that you need kind of when you need it. Mm-hmm. Because all else being equal, if you had 100 shares each worth $1, right? And you normally, and let's say this hypothetical company pays, a $1 dividend, like a 10-cent dividend. So basically it's like giving you $1 a month mm-hmm. in ownership.
Okay.
Right? Income. And so you're like, hey, I have 100 shares and I get my $1. But then all of a sudden the prices go down, but that same $1 goes down a little bit too. And you're like, well, I need a little bit more. Well, I'll just sell one share. Mm-hmm. Problem is, like, now you've sold a share
But now that
you only have 99
less.
shares. So now you lock in the lower amount of income on on a dividend type portfolio, right? So like farmers are familiar with this idea, right? It's like you don't go and sell your heifers, right, to be able to get more beef,
right?
Because that's what's going to produce calves, right? So when the market's down, you have to either be able to avoid and say, well, I'm not going to take money out right now, or you have to be able to say, well, I have an allocation to something else, like, and it could be a plethora of things, right? It could be commodities, it could be bonds, it could be treasuries, it could be just money in high yield savings, it could be annuity money, it could be gold, it could be like all kinds of things, right? It's just, do I have a place that when the market's down on equities, can I pull money from somewhere else? Because if it's all in equities, and although we believe over time equities is going to be the highest return, it can actually really degrade your chances of success when you start having to take out more in down markets. Yeah. The other thing to consider too is the sequence of returns risk, which is like all else being equal. If you have a 10% loss and then 10% gain, 20% gain, and 10% gain, that's going to average out to 10% return, right? But that's going to be wildly different than if you have a 20% return, 10% gain, 10% loss, and 10% gain. It's going to be different. Even though they both average out to an average 10% a year, your situation will be very different.
Yeah.
And so there's this kind of unique risk that even though the return may look higher, not only on paper, that doesn't mean that it's actually increasing the overall return or viability of your financial plan.
Right.
I don't know who is even thinking, like listening to this right now and be like, this is so interesting. I'm such a dork.
Well, I mean, I do think it's super interesting, especially when you look at the charts of it. I guess I'm a visual person, especially when it comes to math and like things like that. Cause I am a financial advisor, but I am not naturally like a math brained person.
Okay.
So I like to see things and I like to visualize it. And these charts, when it shows that like you're having these negative returns in the years that you're starting to withdraw money from, how maybe your overall average return is still higher than somebody else who had, a couple positive returns at the beginning when they're starting to withdraw funds. But their average return is less than this other person.
Yep.
The person who had the positive returns when they start to take out money is going to be better off than the person who had the lower returns when they start to take out money, even though their overall average return is less. And when you're looking at the graphs, it makes it pretty clear. Like you can see like, oh, well, this money, they're taking out the exact same amount, same timing, but their returns were different at the time that they were taking out that money. And so that money is going to last a different length of time because you're having to sell more shares because those shares now are not worth the same value, right? Yeah. So back to when you were talking about the statements and how our statements don't tell us how many shares we own. It tells us the value of those shares at that moment in time. Yeah. I think a lot of people also kind of get freaked out about that sometimes and they'll think about that in different ways and they'll be like, oh my gosh, well, I've lost $20,000. Like, what do you mean you've lost $20,000? Well, they're looking at from one statement like 2 months ago that they were at a all-time high value where their shares were saying, oh, you've gained up to this point and now we're at a point this month where it's gone down. But coming back, I think I went off track from where you were trying to go. No,
you're there. What it did is it sparked what my thought was earlier in talking about that 401k result for that individual is what is lost really anyways? If your cost basis theoretically in an account is $10,000 and your value is $100,000 and then you lost 20%, so now you go to $80,000. Yeah. You still like 8x your money. Yeah. So,
but there's that emotional.
It is an emotional behavior you have to acknowledge.
Well, I lost $20,000, but you really didn't.
And I say this as a guy that believes in market timing and do quite a bit of it. you can't time anything perfect. It's never perfect.
Yeah.
Right. You're going to catch it, you're going to miss the top because you're out early, or, you're going to ride over the top. You know what I mean? Like no one hits the exact top. No one catches the exact bottom. Unless you're like Nancy Pelosi, then, she has a really impeccable timing on all of her trades, it would seem. But outside of that, it's never perfect. It's just, hey, like, can you make prudent decisions that are good enough that help increase the probability of success on your reaching your financial goals, whatever they are?
And I think it goes back to the very beginning of, do you have a full financial plan that takes into account these different types of risk, and are they, allocated appropriately, like the different percentages?
Yeah. Well, if you're looking at your plan and you're looking at risk in your portfolio and you're looking at all this stuff, if you have it all put together really easy, it's easy. It is a lot. It's never easy, but it's a lot easier for people to say, okay, well, we lost some money on my account, but I have 3 years worth of like money in like the safe vehicle and I didn't lose any money there. Yeah. Okay. Well, okay. Yeah. Well, I can wait some time to, let that sort of recover. And that is, that's the point of financial planning, is that way you can define, well, what does that safe spot need to be, right? And how do we define that out early and ahead of time so that we know how we can put money aside and plan for having money available when you need it and not having it be subject to the wrong kinds of risk.
Yeah.
Right? Because money that you may need for the end of retirement might not be prudent to de-risk into money market account if you're retiring early in your 50s.
Yeah.
And in great health,
Yeah.
But at the same time, it may not be prudent for, grandma and grandpa that are in their, late 80s to have a bunch of S&P 500 index funds or something, right? It's like, it might be, I don't know.
It all depends. Do they need that money to live off of, or is that going to be for their legacy, that they want to have it continue to grow for their kids? It all goes back to...
Now you factor in tax situations and what's the cost basis on those funds and how close are they are step up in basis, and what's the probability they might need those funds before they get to step up in basis, which means grandma and grandma died, by the way. But that's... there is just all these complexities and moving parts. So let's talk about, you've been doing a lot of stuff lately. Since you came over, and joined the firm. It's been like 6 months now, 7 months.
So February, close to 6 months,
right?
Yeah.
Is it February or March?
February.
Yeah.
Yep.
You've brought on a bunch of new clients. I see you working hard all the time. You've set up a retirement plan for a business locally. That was cool. So you have a lot of stuff going on. Let's talk about some of the stuff you've been working on recently and maybe some of the challenges that people are facing.
Yeah. So you just mentioned one of them that I've been working on is I've been doing a simple IRA for a small business here in town. They wanted to provide a retirement benefit for their employees because it's not something that they've been able to offer before. And so we've been working through that, and it's been great for these employees who are really just, they're younger, the majority of them. And so they're starting to get a good handle on understanding investing and thinking about their finances. Yeah. So that's been kind of fun.
So really quick.
Yeah.
Let's talk about a simple IRA.
Okay.
So a lot of people, when they think about retirement plans, think they have to do a 401k.
Yep.
And there are a lot of great benefits to a 401k. Tons of bells and whistles. With that comes a pretty heavy administrative lift and additional tax filings, reporting requirements, fiduciary liabilities and obligations. So multiple service providers. It's actually like not a small task always to implement a 401k.
It's a lot of work for the business owner.
Now, for some people, depending on their planning or their business objectives, be very not only rewarding, but almost essential. Okay. But for smaller businesses, they have the opportunity to still do a retirement plan. It's called a simple IRA. And a simple plan allows, instead of having, one big 401k plan that people participate in the plan that way, each employee gets their own IRA. And it's traditional IRAs, but they can still, the contributions or how that account gets funded for the employee comes through payroll, just like a 401, just like people would think about like a 401k.
The salary deductions.
Yep. Salary deductions. The employer does a little match on it for them, so they can still get the matching. So like what I would call like the meat and potatoes of the 401k, like what most people think are important about a 401k when they go like, oh, my company offers a 401k. A simple IRA kind of helps somebody get that, but without a super heavy logistical lift.
Yep.
If they're, just not big enough to, or have the time or interests or resources to implement something more significant like a 401k.
Yep.
And that was cool. I saw like one of the things that I really appreciate about you was that you went and did that. You put in the work to help the business owner establish that, but you actually spent the time to go do a presentation with all the employees and help answer the questions. And then you allowed time in your schedule for them to actually do one-to-one meetings with you so that you could help answer any other questions on like an individual basis so they could get their stuff going the right way. So it actually becomes like a heavier lift on your end to do a simple IRA than a 401k. But I appreciate that that was a lot of diligence and care in watching you get that rolling. And I know they're very grateful down there.
I just think it's important, especially where a lot of them are younger and they haven't had the opportunities before. They only know what they know. And so being able to sit down with somebody who's a financial advisor and help them kind of create a full financial plan. I mean, we're not going into super deep depth with them, but I'm helping them with, debt payoff plans, figuring out, how much can they contribute and make that a reasonable contribution for them. Yeah. What does that look like? And then, as they max out those contributions, what are their other options down the future? And, what does that look like for them? So just kind of helping them get motivated about their own personal finance. And it's been really fun for me to see that because I actually really enjoy like the educational part of it and the one-on-one coaching stuff. So that's been really fun.
Yeah. What a great employee benefit that probably wasn't a part of the calculus, but that a lot of those employees now have some basic financial planning. They really get them going in the right direction.
Yeah.
That came through an individualized advice out of with a fiduciary capacity, right? Like you weren't there, selling them more stuff or something, just helping them out.
Yep.
So that's super cool.
Thanks.
What else have you been working on?
Another thing as far as small businesses have been, as small businesses go, I really enjoy working with small business owners too. So I've been talking with a couple small business owners and clients that are really focused on, how do I get my cash flow in order for my business and make a profit, and then also having that translate into their personal finance as well. I think a lot of business owners, small business owners, I'll specify that, they are really good at what they focus on in their business, but they're not necessarily really good at the finances and the business administration part of it. And so coming in and doing like an overall plan with them for their businesses and their personal finance and helping them figure out like how to cut costs, what type of documentation should I be looking at, what kind of numbers should I know for my business, and helping them get a better understanding there so that they can also look at, what's their exit strategy for their business down the road and in the future. And can we plan for, do some tax planning strategies for that as well. And how does that lead into their personal finance situation too, so that they can not only provide for their family while they're working on this business, but when they sell that business or transition or, retire or whatever stage they're in there. So I've been working with a couple people on that, and that's been fun.
Yeah. Yeah. If you own a business, it's like owning stock in a company that's, paying dividends. And when you retire, you can try to keep the stock, right? And, keep collecting dividends. You can sell it, cash it out different places, reinvest it. You have options. But the one thing that I'll say is if your business isn't profitable, it's like owning a value stock that doesn't pay dividends. There's no value and no one's going to want to own it.
Yeah.
So just factor that in. If you are the business, then plan accordingly.
Yep.
Right.
Yep. Another thing that I have been working on lately, there's a new client that I met who, unfortunately, she lost her spouse, so she's become a widow. And so her life has just completely changed, right?
Yeah.
They were married for a long time. She's in her late 60s. And so she still has a long time in retirement to
wow.
go. But her entire life has changed. All her financial planning, everything that she thought she knew before is now different. Unfortunately, her and her husband did have a substantial amount of debt when he passed. And so that was a burden that was weighing on her. And so, looking through her situation and really discussing that, luckily she had some family members who were willing to kind of step in and help her go through this process. So she wasn't stuck in that like paralysis mode of not doing anything.
I think that's how she found you, right? One of her kids referred her.
One of her kids referred her to me. And so he was able to help her, kind of sort through a lot of that personal stuff. They ended up selling the home. And because they did have equity in their home, they're able to utilize that money to pay off their debts. So now she's debt free and has some money left over that's going to help her through her retirement. But she recognizes that she has a habit of spending money and she's never had this much money before. And so she's afraid that she's going to like squander that money or not have enough to make it last for as long as she needs it throughout retirement. Yeah. And so we've been working through kind of some of the money management skills and some of those behavioral skills as well. And then creating a really good plan where we have kind of like we talked about earlier, the growth aspect of it to help combat inflation and be that long-term plan for her. And then we also are going to be doing some of the safer money because she inherently has a lower risk tolerance from her experiences previously. And so we're looking at some different options for her for that quote unquote safe money where we're protecting the loss of principal. And then trying to give her just a set amount each month so that she can work on those budgeting skills, the money management skills, and make sure that she's living within her means. And so a lot of education going on there, lots of just helping her feel more comfortable in her new situation and understanding how one decision can impact all of these other areas of her life. And so making sure that she feels comfortable and confident to make the right decisions for her financially going forward.
Yeah, I like that. You have to, I like what you're doing there with, it's gotta be a program that doesn't just always look good on paper. It's gotta work in real life.
Yeah.
And there's two things that'll blow up someone's financial plan, right? And it's position sizing and it's their own behavior. Those two things will blow people up faster than anything else. And coaching somebody through how to, get money, how to view money, how to, and this happens actually a lot with older spouses that outlive there's typically in a family dynamic a spouse that is like the quote unquote like the money person and the one that's not. And when the person that's not the money person survives, and I've seen this a number of times already in my career where I've sat down and talked to people and they think they are, and for what it's worth for anyone out there listening, this happened to my own grandma to a certain extent. They thought they had like next to nothing, right? Like I worked with a client one time that had finance. She needed a new car and she financed it at the dealership with very unfavorable terms because she didn't really have income, and I'm going like, why'd you finance that car? Well, I don't have any money. And now I don't have any money for sure because I am making this payment every month. And I finally just had it all organized and pulled out a net worth statement for her. And I said, your net worth is almost $2 million. We can pay this car loan off. Yeah. Now this was a new client that had actually been referred to me by a real estate agent, and just helping this individual get organized and understand what she had access to and the decisions that she could make. She was so shocked to know that's what are you really? Oh my gosh. I go, yeah, like you're going to be okay. Yeah. And But now the next step is, oh, well, I didn't realize I had that much money. All right, let's party. Yeah. We're pretty close to Vegas here. It's or whatever. That stuff can happen too. So that you have to. It's like old Uncle Ben says, with great power comes great responsibility. So if you have the power to show somebody, hey, you actually have a lot of assets and you really have the ability to go out and do this stuff, you also have the responsibility to help them do it responsibly. Yep. And help them manage that cash flow and help them figuring out how to manage their budget and do some finances on their own, right? I'm a big proponent of teach them correct principles, let them do it themselves. Mm-hmm. I don't care to get into the weeds and help people figure out if they should, have a Spotify subscription or not, you're still an adult. But helping somebody at least get started and understanding that and how to do it is super important. And there's nothing in that for you. No. I know that because I run the finances of this whole operation. You don't make any money doing that. It's just the right thing to do though. And so I appreciate that about you.
Well, thank you.
Good for you. I think, we're setting them up for, I think a good chance at success here.
Yeah. I heard recently, this quote about financial advisors and financial planners, and it's just kind of been stuck in my mind of financial advisors and financial planners. They don't provide, let me start over with that. Financial advisors and financial planners, they don't provide certainty. Okay, we can't guarantee anything, right? We can't provide certainty, but what we can provide is clarity and confidence with your finances. And so, I think that's really what I try to do with my clients is help educate them and let them see for themselves, have that clarity around what their situation is, whether that's good or bad. Sometimes we need to be that, give them a little bit of that tough love and show them, you're spending a little too much, or, maybe we need to take it back a step, or, hey, on the other side of it, you've got plenty of funds. Why don't you go take a vacation or do something fun that you've always wanted to do? We can give them that clarity and that confidence, that peace of mind around their finances so that they know what's going on, they know what to expect, and they can make the right decisions for themselves. Because ultimately that's what our job is, right? We give advice, but then it comes down to what the clients actually do. They can take our advice or they can leave it. Hopefully they take it.
Hopefully they take it. I may be biased, but I think most people would be better off if they took it. Yeah. But take that for what it's worth. I think we really try to do a nice job being full service for people and understanding that they're human beings. And what's interesting is any given day, we have the whole gambit of conversations, right? We can go from one meeting where we say, you can keep spending like this. Here's the results. You're going to be out of money in 3 or 4 years. To the next meeting, hey, you can keep spending like this, but you have enough money for 2 generations of people behind you. We really need to talk about your estate planning and actually getting rid of some of this money. What do you want to do with it while you're alive? Yeah. Right. And everything in between, all in a day's work at Ducharme Wealth Management. Yep. Anything else that you've been working on that's exciting or fun or? Those have been kind of the main things. I've had a client who's a high income earner, new to the wealth management world. Thought about it for a long time, but just didn't really know if it was right for him or not. And so they were a referral. They came to me and we did a consultation and started showing them some of these different things that they didn't even know that they didn't know. He's been doing a great job. He's got a great 401k. He's been maxing out every year. But even within that 401k, he was just in a target date fund. And so, that can create some problems in itself, especially when he's ready to retire. And then having all of his money, we've got concentration risk, we've got market risk, we've got liquidity risk, we've got different tax things going on. And so we were able to create a really good holistic plan for him so that now he knows, looking at his future when he is ready to retire in 8 to 10 years, that he knows what that's going to look like. He doesn't have certainty, but he has a lot more clarity and confidence around all these different areas of his financial plan that he didn't even think to look at previously. Yeah. Well, I know with that case, and we've worked on that a little bit together in the back, in the office. some really important things when you start getting into high income earners is the tax efficiency and the tax planning side.
Yep.
And everyone has different goals, and your goals drive everything, right? Your goals drive your investment decision. And I always say, don't let the tax tail wag the dog, right? Like tax isn't the objective. It's a passenger on the bus. Okay. Like you gotta take into consideration, Mr. Tax and where he wants to stop for lunch too, but like, we're not letting him drive the bus. Okay.
Yeah.
But when all those things come together, there are opportunities to look for efficient ways to help somebody with charitable giving to maximize tax structure. And that integrates with an investment plan, like in a big way.
Yep.
All kinds of stuff. And that's been some fun stuff to work on with you. I'm very excited about all the stuff we're doing. We've had so many things going on this year.
Yeah.
And we have even more cool tools that we're rolling out, going into Q4, I think this year.
Yeah. I'm really excited for it.
Yeah. I think, a big win I've had recently was, around tax planning and helping somebody, realize that, they're like in early retirement, working part-time. They had, money in a brokerage account, and they're kind of just like in that mode where they're not pulling on their investments. They're working part-time and just like life's great, good, good and happy, not really doing the Social Security thing yet, but not high income, low tax brackets, all this good stuff. And, I was like, well, why don't you put money in your Roth IRA? Oh, well, it's like, but he's not making a lot, right? This person's not making a lot of like extra money, like from a free cash flow standpoint.
Yeah.
I said, why don't we just move it from your brokerage account into a Roth IRA, right? It's like, it's your own money. Your brokerage account's your own money. Okay. So like use that to fund your Roth IRA and pick up a saver's credit. And the accountant signed off, so we, earlier this year, I kind of made that proposal. The accountant signed off on it. And, that's going to, make him, he'll get a couple $1,000 in a tax credit just for moving money from one account to another, right? There's kind of no impact to him. And that kind of stuff doesn't make us any money. You know what I mean? Like we don't make money that way. But they hired us to look out for him, and that's what we did. So just in a thorough analysis, like picked up something that was like a little, really like kind of a niche thing. Like most people wouldn't be in a situation where that would make sense. But we got it.
Yeah.
And it did make sense for that individual. And it was a cool little win.
That's awesome. I just want to point out that I think it's really cool too, that you are looking for those opportunities, but then also, like confirming with that person's accountant, because I find that a lot of advisors just won't even, they don't want to really work with other professionals because they're like, well, this is what I found. And so this is what we're going to do.
So,
or they don't even want to talk about anything tax related because, they're a little bit nervous too because of different things.
Well, here's the deal. I'm not a CPA, and that's not to say that I can't look stuff up on the tax code.
Right.
And I can't, like, it's not to say I can't research anything. It's not to say I can't do tax planning. What it is to say is that I'm not going to be the person that files a return, stamps my name on it, and sends it to the IRS. Yep. So as a common courtesy, talk to the person that is going to do that when you're making tax decisions and just say, hey, like, am I missing something here? Yeah. Right? Like, I'm not, like you said earlier, you can be like, I don't know what I don't know.
Yeah.
And if you're unwilling as an advisor to say that there's things you may not know, you need to get out of this business, because there is a lot that you don't know. And there's a lot that we all don't know. And you have to be willing to say, I don't know everything. I need to look into that more. I need to talk to some professionals. I need to talk to some other, someone that specializes in that, or I need to look it up. Yeah. Whatever it might be. You might have to get on the phone with the IRS. I don't know. But the point is, have some humility, right?
Yeah.
And ask the right questions. And yeah, if somebody else is going to have to stamp their name on your work, like a CPA is going to have to stamp their name on my tax planning, basically, get them involved. Say,
Well, and
does
it
this
makes
make
them feel a
sense?
lot more comfortable understanding it
Yeah.
from your perspective rather than just having the client go and say, hey, does this work?
Oh,
Because
yeah.
the clients oftentimes don't understand enough of the background to be able to explain it to the CPA of why maybe we're
Yeah.
recommending this.
Yep.
And so then things can get lost in communication. So just the fact that you are willing to communicate directly with that CPA on behalf of the client and make that happen for them, I just think that's a huge value add to your clients. So
I would think so too, but that's what I do. Cool. And for what it's worth, estate planning is like the same way.
yeah. Yep.
Anything like that you have to, the other big one would be business attorneys. Like if you're going to help some business owners, we've done that in the past, a reasonable amount, helping people set up like buy sell agreements or cross entity purchases. And then, using, life insurance or disability insurance typically to fund those agreements. Like, don't just make your recommendation and then like sell them the product and be like, well, best of luck with your attorney to draft those documents.
go.
It's like, ooh, that's
Yeah.
okay. We have an idea here where we're trying to take this. Let's bring in the attorney.
Make
Let's
sure
ask
it
the right
works with
questions.
all
Let's
the
have the
different areas.
documents drafted the right way. And then let's put them in, let's put those documents into place the same time that we put insurance into place to fund them. So it all happens at once. And there's not some, crazy risk out there because you have half the plan.
Yeah.
So anyways, well, cool stuff. For what it's worth, my prediction here, going back to the political conversation we opened up with,
Okay.
it's my prediction. And I feel pretty confident in this one. So regardless of which president wins the election, the markets will, and get this, be higher or lower than they are today.
What a prediction.
Yeah. I'm going to put my money on either of those, probably not put it at the exact same spot, would be my guess. So for what it's worth, I don't know. That's not 100%. I didn't make 100% call there, right? Like,
Yeah.
I did make a call. But if I had to say even further than that, I'd say I feel pretty good from a technical standpoint and a cycles analysis standpoint that the markets are probably going to be just okay, are going to be okay, regardless of who wins. So take that for what it's worth and what I just charge you to hear that, which is nothing. And use the logic as best you can, guys, when you're looking at your portfolios and trying to make some planning decisions out there, especially around the election.
And keep your
election.
long-term plan in mind.
Yeah. Don't deviate from your, like, if you have a 40-year plan, why are you going to make a decision change based on the next 4 years?
Yeah.
And we live in we're very blessed to live in a democratic republic, and there is multiple branches of government that have systems of checks and balances. So regardless of who wins, like, one of the most amazing things is that sometimes this country can't do anything. That's one of the best things about government, is sometimes they just can't figure out how to do anything. And sometimes when it comes to them not doing anything is better for the markets. Okay.
Yeah.
I don't want to get political, but from a market perspective, when they do nothing, it's oftentimes better than something.
Yeah.
Because markets just like predictability. And so if predictably they can do nothing, then you know what environment you're at least investing in and working with, as a business or an investor, right?
Yeah.
So yeah, play the long game. Central bank digital currency, I'm calling bogus on it. I just don't. I mean, I could do a whole podcast episode on that. Gold, it has its spot in a portfolio, has its spot in a financial plan. Better to find what that is. I would be cautious people against getting too heavy allocated in that by any means. Dear God, please do not do the self-directed IRA option. I think that's wildly inappropriate for most people to, when it comes to holding gold. It's actually some significant costs that it carries, and it accomplishes, what I find is most of the time it accomplishes none of the things they were wanting to accomplish.
Yeah.
Right. All of the things that they were that were going to help them feel good or sleep good at night or whatever, they were going to actually get none of those things. And if you get the things that were going to help you feel good and sleep good at night, you're going to run into disastrous tax issues with the IRA. Okay. So caution people around that. Sorry, Ben Shapiro, Birch Gold Group. I'm going to call them out. I don't like the idea. for a lot of people. Everyone's got their own circumstances, so talk to your own financial advisor. But
just make sure you fully understand.
You better
all of it.
fully understand. And there is a great book if you're ever thinking about doing a self-directed IRA called the Self-Directed IRA Handbook. Mm-hmm. And it will help you understand all the implications and nuances of that. But it is like 190-ish page book, 200-page book or so of legalese and legal terms and concepts. And it's a lot. And so you might just reconsider how you do all that.
Yeah.
Some other quick things I've been seeing or hearing about recently. I maintain that I think the infinite banking concept or, being your own bank with life insurance is not as exciting as people make it sound. If you think it is and you want to come on my podcast and tell me about it and help me understand where you think my flaw is and my logic, I'm more than happy to try to learn more. I totally acknowledge that I may be seeing things wrong, but I'm fairly confident that I'm not. Yeah. Just contradictive in and of itself.
But you're open.
I'm
open to learning, and I think that's what's important.
I'm open to learning, and if somebody wants to come on and talk to me about it, let's do it. Same with whole life. I would say, same with any other hyperbolic or like very common thing that's on social media right now. Real estate, insurance, crypto. If there's someone out there that likes crypto and they want to talk about crypto, I'm not a crypto expert. I would like to learn more about crypto.
Same.
I'm not a crypto novice. Like I'm not a complete, I have some baseline education on crypto, but I'm by no means an expert.
Yeah.
And I'd love to learn more about that. But like in the context of what's a fun conversation for me, because I don't have the time to commit fully to that right now. That's a whole world. And I got CMT3 to study for in December.
It's coming up. It's coming up fast.
What is the most disastrous sales pitch you've heard recently?
Oh my
We
gosh.
hear them all the time. We're going to wrap on this. Give me your worst one.
I'm trying to think. I'm just thinking of like TikTok and Instagram Reels stuff that I keep seeing all the time. And it kind of goes around like the permanent insurance and taxes, a lot of it, and real estate. Let's see. One of the things that I've been seeing a bunch is now I'm forgetting what it's called. That exemption where basically when you have an Airbnb and then you can rent it out for yourself for like 2 weeks.
The
Augusta rule.
The Augusta rule.
The Augusta rule.
Okay.
I feel like that one's huge on social media right now, and people don't understand the implications of that.
I think that's actually section 208A of the IRC, if somebody wants to talk to their accountant about it.
Yeah.
I believe that's...
I just think the whole point is be cautious on social media when you see anything that sounds too good to be true. Like, do your research. Talk to a professional. Don't just rely on somebody who is going to benefit from.
I'll tell you right now, some of the best stuff is just not going to be on social media.
It's not.
And I'll tell you that because I'm on social media quite a bit, both in observance of social media, but obviously my appearances on social media. Mm-hmm. And looking at my own toolbox of tools, we do not discuss the best. It's because it's too individualized.
I was going to say, I think the main thing is
because it's like a secret.
People will
it's just
ask
too
me all the time,
individualized.
oh, you're a financial advisor. What should I be invested in right now? Like, what's the best investment right now? And I'm like, well, what are your needs? What are your goals? What's your financial situation right now? Like, tell me your whole financial picture, and then I can give you a recommendation.
Not a stockbroker.
But I can't just pick one product or one service and say, oh, you absolutely should do this. Everybody should do this.
Yeah.
Because that's just not how personal finance works.
If
It should be personal.
I always wonder when people ask me that question, I like, sometimes I wonder, I'm like, is that the test?
Is it a trick question?
Is it a trick question? Like, I'm going to ask this guy, and if he has an answer,
Yeah.
then he's full of crap and he's a salesman, or whatever. Yeah. It's like, I'm just looking for the guy that says like, I don't know what your situation is, man. I couldn't tell you. Yeah. It's like, because there is just not really
There's just
another good.
No one thing fits all.
Yeah.
It's just not.
Like, and I love those conversations. I love like the conversations around investments are my favorite part of this business. And I love that significantly more than, estate planning, insurance, taxes, all that kind of stuff. And that stuff can be fun. And I don't get to talk on the podcast a lot about investments because it's so individualized and because it's, it's hard to talk about. Yeah. Right. And it's hard for people to understand.
Well,
everything.
You got to make sure compliance doesn't think it's construed as a recommendation.
Well, or just like if I started talking about the technicals of the market and
that's the stuff that makes most people's eyes like glaze over and like zone out. But anyways, for you, that's your passion.
That's my jam. So when people ask me, I like asking some probing questions, and I'll say like, well, you might consider a couple ideas, right? Or like, here's some things to like do some more research on. And that's fun. But I like if you're like, what's the best investment? Someone's like, oh, XYZ stock. You're like, okay, well, you probably, whew.
Do you even know what all is out there?
Yeah. Well, anyways, I explained recently, a fun conversation I had recently was, with a insurance agent actually, that explained to me in their words, what the concept of infinite banking with an index universal life policy was. And it gave me all the explanations of why they thought it was great. And I said, okay, well, so could you do XYZ other things here and basically just create your own index universal life policy, but without having to deal with the insurance company. Right. And like, they're like, whoa. And I'm like, well, it's fun to strategize.
Yeah.
It's obviously different, but it was what I had proposed to them as a concept accomplished the goal of what they were trying to do with the life insurance contract.
Right.
So it just depends. It's always fun. But
yeah.
Anyways, okay. We're like way over on time. This is a wrap. Yeah, this is a long old episode. Yeah, we both got to roll. I got to get back to the office. Okay. All right, everyone.
Thank you.
Always open to different guests. If you have an idea, you think we're wrong about something, you want to know more, come on the podcast. If you just want financial advice and you're open to the whole world hearing it, you want to come on the podcast and talk about your own situation, we will let you come on the podcast and we'll answer your questions.
That would be fun.
That way. And then we won't bill you for it. We won't bill you for our time. That's an option, I guess.
Yeah.
Anyways.
Let us know.
Reach out to us. You can find both of us on the website at Ducharme Wealth. And you can obviously find us on all the socials. You're already watching this.
Yep.
Carisa at DucharmeWealth.com or Brandon at DucharmeWealth.com.